Warren Buffett's first $1 million, the gas station secret. Warren Buffett made his first $1 million at age 30. But the way he did it is not what you think. It wasn't stocks, it wasn't real estate, and it definitely wasn't inheritance. It involved a gas station in Omaha, a pinball machine business run by a teenager, and over 40 newspaper delivery routes. In this video, I'll show you exactly how Warren Buffett turned $114 into his first million before age 31. The 3 businesses he actually ran, the investments nobody talks about, and the one strategy that changed everything. By the end, you will understand why his approach still works today and what you can learn from it. Let's dive in. Warren Buffett was born in 1930 in Omaha, Nebraska, during the Great Depression. But here's what's interesting. While most kids his age were playing outside, young Warren was obsessed with one thing: making money. At age 6, he bought 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents. Then he sold each bottle individually for 5 cents. That's a 20% profit margin at age 6. By age 11, he bought his first stock, 3 shares of Citi Service Preferred stock, for $38 per share. He sold them at $40, making a small profit. But then, the stock jumped to $200. This taught him lesson number 1. Patience pays more than quick profits. But here's where it gets really interesting. While in high school, Warren wasn't just delivering newspapers. He was running actual businesses. The teenage entrepreneur. At age 15, Warren Buffett spent $25 to buy a used pinball machine. Here's what he did next. He convinced a local barber shop owner to let him place the machine in the shop. The deal? They'd split the profits 50-50. Within months, that single pinball machine was generating enough profit to buy a second one, then a third, then a fourth. By the time Warren graduated high school, he owned multiple pinball machines across Omaha, operating under the name Wilson Coin Operated Machine Company. The business was generating serious cash, but Warren never even told his classmates he owned it. By age 16, Warren Buffett had saved over $6,000. That's equivalent to about $90,000 in today's money, on pinball machines and newspaper routes. Most teenagers were asking their parents for allowance. Warren was already thinking like a businessman. His father pushed him to go to college. Warren reluctantly agreed, but he didn't stop working. At the University of Pennsylvania, he continued running businesses. He and a friend bought a used Rolls Royce for $350 and rented it out for $35 a day. Do the math. That's a 10% return on investment per rental, and they rented it constantly. But then, something changed everything. At Columbia Business School, Warren met Benjamin Graham, the father of value investing. Graham taught him a principle that would define his entire career: buy undervalued assets and hold them long term. This was the missing piece. Warren now had the business skills, the capital, and the strategy. The road to $1 million. After graduating in 1951, Warren returned to Omaha with about $10,000 saved. Most people will think that's not enough to build wealth. Warren thought differently. He started applying Graham's value investing principles aggressively. He'd read annual reports, hours, looking for companies trading below their actual worth. Companies Wall Street had ignored or undervalued. One of his major first investments was Western Insurance Securities. The company was trading at $16 per share, but Warren calculated its real value was closer to $100 per share. He bought as many shares as he could afford. Within a few years, the stock price caught up to his valuation. That single investment multiplied his money several times over. But here's the part most people don't know. In 1956, Warren Buffett bought a Sinclair gas station in Omaha with a partner. This was supposed to be a safe, steady business, a way to diversify beyond stocks. It failed miserably. The location was poor, competition was fierce, and Warren quickly realized he knew nothing about running a gas station. He sold it at a loss within a year. This taught him lesson number 2. Stick to your circle of competence. Warren never tried to run an operational business again. He focused exclusively on what he was brilliant at, analyzing companies and buying undervalued stocks. In 1956, at age 26, Warren started his first investment partnership with $100 from 7 family members and friends. He contributed $100 of his own money. The deal was simple. Warren will manage the investments. Investors will get 6% annually, and Warren will take 25% of any profits above that threshold. And then he went to work. Between 1956 and 1960, Warren's investment partnership returned an average of 25% per year. The S&P 500 averaged about 10% during the same period. His investors were thrilled. Word spread. More people wanted in. The partnership grew from $105,000 to over $500,000 in just 4 years. And Warren's personal share, it was growing exponentially. He also bought a 400-acre farm in Nebraska for $280,000 in the late 1950s. Not because he wanted to farm, but because the land was undervalued. He leased it to a tenant farmer and collected rent. Classic Warren Buffett. Buy undervalued assets, hold them, let them appreciate. By 1961, Warren Buffett's personal net worth crossed $1 million. He was 30 years old. How he actually did it. So let's break down exactly how Warren Buffett made his first million. Strategy 1. Multiple income streams early. From age 13 to 21, Warren had newspaper routes, pinball machines, and small business ventures constantly generating cash flow. He didn't rely on one source of income. He stacked them. Strategy 2. Extreme savings rate. Warren saved nearly everything he earned, while his friends were buying cars and going on trips. Warren lived frugally and invested every dollar he could. By age 21, he had saved $10,000. That's equivalent to about $120,000 today. Most 21-year-olds today have student debts. Warren had capital ready to deploy. Strategy 3. Value investing discipline. Benjamin Graham's philosophy changed everything for Warren. Instead of chasing hot stocks or trends, Warren looked for companies trading below their intrinsic value. He'd buy them, hold them, and wait for the market to realize their true worth. This wasn't gambling. This was calculated, patient investing. Strategy 4. Compounding through partnerships. The Buffett partnership structure was genius. Warren took a percentage of the profits, which he then reinvested. His investors' money grew. His money grew faster because of the profit share. It was a compounding machine. Strategy 5. Focus on cycle of competence. After the gas station failure, Warren learned to stay within his expertise. He didn't try to be good at everything. He became exceptional at one thing: analyzing and investing in businesses. From age 6 to age 30, Warren followed a simple formula: earn, save, invest, repeat. Not get rich quick schemes, no lottery tickets, no shortcuts. Just disciplined, consistent execution over 24 years. What you can learn. Now you're probably thinking, that was the 1950s. Times were different. This doesn't apply to me. Actually, it applies more than ever. First lesson: start early, start small. Warren started with a $25 pinball machine. You can start with $25 in stocks, a side hustle, or learning a valuable skill. The amount doesn't matter. Starting matters. Second lesson: multiple income streams win. Warren didn't rely on one source of income in his 20s. He had newspapers, pinball machines, rental income, and investment returns. Today, you can have a job, a side business, freelancing, and investments. Stack your income. The third lesson: save aggressively, invest wisely. Warren saved 50 to 75% of everything he earned in his teens and 20s. Most people today save less than 10%. If you can increase your savings rate and invest the difference, you compress decades of wealth building into years. The fourth lesson: patience beats speed. Warren held investments for years, sometimes decades. In a world of day trading and crypto gambling, patience is your competitive advantage. The market rewards those who wait. The fifth lesson: know what you're good at. Warren tried running a gas station. He failed. He stuck to investing. He became a billionaire. Find your zone of genius. Double down on it. Ignore everything else. Warren Buffett is now worth over $100 billion. But it all started with pinball machines, newspaper routes, and a $25 investment in a used game. His first million took 24 years of discipline. His next millions came faster because of compounding. A call to action. The lesson: you don't need to be born rich. You don't need connections. You don't need luck. You need discipline, patience, and a willingness to learn. Warren Buffett's origin story isn't about genius. It's about consistency. From $114 at age 11 to $1 million at age 30 to $100 billion at age 94. Same principles, same discipline, just compounded over time. If you found this story valuable, subscribe to Billionaire Origins for more deep dives into how the world's richest people actually started. Next week, breaking down how Elon Musk made his first $22 million before Tesla even existed. You won't believe what he had to sacrifice. And here's my question for you. If Warren Buffett started today at age 21 with no money, could he still become a billionaire? Let me know in the comments. Thanks for watching. See you in the next one.